Why does refinancing your mortgage seem like the only option when you're looking for help with your debts? Stay tuned for the answer. So listen, guys, when you go to a bank and you have problems with debts, it is very customary for a bank to either give you one of two options. First option is if you don't own a home, the first thing they try to do is sell you on another piece of debt to either consolidate all those other debts, and that this might be even something you expect. This is something that you go in there to ask for. And why do people do that? Basically, you're basically covering up a wound with another wound, basically. Okay, it's not going to scar over and heal itself. It's another wound to your financial house. Okay, and so all you're doing is hopefully freeing up some cash flow, because that's the whole idea, is so that you have maybe one payment and more cash flow to pay towards other things. The other reason why people do this is because they feel like it saves them on interest. So instead of paying 25% on a bunch of credit cards, they might be able to get a loan around 10%. And that seems like a lot big of a difference. But a debt's a debt. So what you're doing is you're paying off debt with another piece of debt. The biggest drawback to that is most financial institutions will not close out the credit cards that you consolidated into that payment, consolidated into that debt in the first place. So what do most people do is now they feel like, oh, I have so much money because they freed up a bunch of cash flow from this consolidated loan, that they just kind of go back to their spending habits and rack up the credit cards that they never closed in the first place. And what happens next? Oh, they run back to the bank and they say, oh, stupid me, I did it again. Can you do it again? And so I saw this lots when I was out at the bank. And I mean, believe you and me, as much as it sounds logical, especially in a situation where, things are really hard money-wise and you're living paycheck to paycheck, it feels like a little bit of relief, but you need to take perspective on what you're actually doing, especially if you're not one to actually look at what spending habits got you there in the first place. Because if you don't fix that problem, the symptoms of being in debt and then feeling drained by that is not going to go away. You have to fix the problem first, right? Fix the spending habit problem first. So the banks are open to giving you that debt because guess what? They make interest, right? And that's part of the reason why they don't require you to close their credit cards, because they want you to use their credit cards because they also get interest like 25-30% on the credit cards that you have with them. So they have a vested interest to keep you in debt. Okay? Now, I would warn you that if you do ever needed to go into a consolidated debt, go into your bank and try it that way first. If you assume that you have relatively good credit, of course, and a good income coming in. I wouldn't go for those payday loans. Sometimes those are the last resort. But I think if you're already at that point, you definitely need to see a financial coach like myself that can help guide you to get you out of the spending habits that you're in. But if you do have to go into a consolidated loan, my advice to you is to not do it ever again, right? Actually hunker down on the problem that got you there in the first place. Okay, easier said than done, but 100% possible. And I mean, at the end of the day, you do want to get out of debt, don't you? Now, another second option that the bank might present to you if you're ever in a case where you have a lot of debt is a refinance mortgage. And of course, you have to own your own home in that case. There are some stipulations, like you have to have enough equity in the home. And I mean, depending on the financial institution, usually you have to have at least 80% equity. What does that mean? Sorry, you have to have at least 20% equity in your home. Now, what does that mean? It means that your current mortgage, assuming you have a mortgage, probably do, assuming you have a mortgage, your mortgage must be at least less than 80% of the value of your home. Okay, so if you did the math, let's just pretend your house is worth $500,000. Your mortgage cannot be more than 80% of that. So 80 times 500,000 is 400,000. But that doesn't mean that you can get a refinance. The refinance debt part has to be included in that 80%. Okay, so for instance, in that same example, if you have a home that's worth 500,000, which is valued by the bank, by the way, they usually order their own appraisal to help determine what value your home is. You can't just say, hey, my house is worth this amount of money, unless it's backed by your city assessment that says this is how much your house is worth. That's the only time they'll consider an outside appraisal. But anyways, so same example, 500,000 your home is worth, and let's say you have a $400,000 mortgage owing on that home. You can't refinance anything because you're already at that 80% loan to value mark. But let's say that your mortgage is $300,000 and your house is worth $500,000. We already know you can go up to 80% value of your home to refinance. So if your mortgage is $300,000 and you can go up to $400,000, then you have about $100,000 that you can play with to take out and pay off other debts. Okay, and this is very popular. In fact, I would probably advise you that if you're gonna do this, make sure that you keep your amortization the same. Okay, what do I mean by that? When you signed up for your mortgage, chances are you took a 25-year mortgage or a 30-year mortgage. I mean, back in 2005, 2006, 2007, in Canada, they went up to 40-year mortgages. But either way, you keep your same amortization. Do not let the bank extend it out. And this is how they get you. Fun fact, if you actually do the math on how mortgages work, the first 14 to 15 years of the life of your mortgage, you'll see that your principal goes down quite slowly in the first few years of your mortgage. Most of it is going towards interest, okay? And you'll see at the 14-year mark, maybe 15-year mark, that you start to see, kind of a balance between part of it going to principal and part of it going to interest. So if you re-extend your amortization back to 25 years, if you had to refinance, you're back to square one. The banks want you to do this, right? Because they're getting so much more money in the first 14, 15 years of that mortgage because you've refinanced and you've refinanced up to back up to 80% of your home value. They're making money, right? At the same time, they're doing it for another 15 years. They have you in handcuffs for another 15 years, at least, because they know that most of the payment you're putting towards your mortgage is going towards them, not you, not ownership of that house. So if you're running into problems, though, and you do have a bunch of debt, those are kind of the two options that most banks will kind of direct you to. I prefer to try other things before that, because I believe that there are ways to stay out of debt and really manage your money so you can get out of debt and then at the same time stay out of debt. So reach out to me. Click the link in the description box if you wanted to have a talk about your situation. It may be very well so that I advise you to go to your bank and ask for, a specific loan or refinance your mortgage. That might be an option when we look at the whole grand scheme of things, but don't rely on that being the only solution, because there is a deeper lying issue or deeper lying problem that exists that brought you there in the first place. And we want to kind of get rid of that problem so you never have to face that again. I hope you got value from that. Subscribe to my videos, guys. I hope that they bring value to you. Reach out to me if you're starting to feel a pinch. I got you all. Have an awesome day.